Good morning, everybody. Rob Barnes with Integrated Insurance Consulting. We're going to start our program right now. Today, we'll go through some high net worth case studies showing the use and value of life insurance. Some of them are actual client situations I've been involved in, but all of them are viable strategies where life insurance helped or can help secure an outcome. You see, life insurance is simply a financial tool, a tool providing leverage and liquidity. It offers unique benefits, including power of contract, tax-deferred growth, tax-free proceeds, and protection from creditors. High net worth clients use life insurance for many reasons: to secure the transition of their business, to avoid a liquidation sale of their assets, to enhance their legacy to family or charities, and of course, to pay estate taxes. Estate planning and estate tax planning require different thinking. The axioms of estate tax planning tell us it's not what you make that matters, it's what they keep that matters. They tell us don't die the richest guy or girl in the graveyard. Gift assets, shrink assets, freeze assets, and leverage assets. You want to minimize the bad assets to die with and maximize the good ones. You see, the estate tax laws are kind of set up simply in this vein. If you've been successful to a certain point or above in America, you need to contribute to society. Now, you can do that through social capital, i.e. pay an income or an estate tax, and they spend it the way they want to, or you can self-direct your personal capital to organizations that matter to you. Estate planning specialists will tell you there's two estate tax systems, one for the informed taxpayer and one for the uninformed taxpayer. The less you know, the more the IRS takes. But hold on, we know that knowledge itself is not power, it's the application of knowledge. So in reality, the less you do, the more the IRS is going to take. Comprehensive estate plan for persons with large estates must incorporate one or more of these strategies. You need to use techniques to reduce or shift the value of assets. Implement programs which take advantage of income, gift, and estate tax deductions for transfers to charity. And of course, leverage of cash gifts through the purchase of life insurance held outside your taxable estate in trusts and so forth. So if I may use a football analogy, we're trying to move the plan down the field. We're starting in one end zone where we do no planning and we'll have no say in our social capital. And for some, they want to get all the way to the other end where there's no tax and they self-direct their social capital, whether that be to church, charity, or their own foundations. So it's a lot of work to get down the field. You have to create living trusts and power of attorney and healthcare powers of attorney, and you have to pick your guardians and your trustees and your executors. You need to be making lifetime gifts. Look into irrevocable life insurance trust and spousal lifetime access trust, perhaps buy life insurance. Use qualified personal residence trust when appropriate. Use sales to intentionally defective grantor trusts. For those with businesses, you might create a family limited partnership or a family LLC. You might use grantor retained annuity trusts or private split dollar or premium financing, but along the way to get here, lots and lots of attorney fees. But here we are, we're in the red zone. We're ready to score to the no tax zone. All we have to do is give the rest away. Make charitable gifts, use charitable lead trust, charitable remainder trust, and family foundations. This is the work to get all the way to the other end of the field, and very few people ever get there in reality. So in football, what do you do when you want to score fast? Well, you do the Hail Mary or you throw the bomb, as they say. And so I want to just briefly mention a story that we're working on with John and Mary. John and Mary live in Illinois, and they have a $7 million estate. But of that $7 million, $3 million is John's IRA. And so even though the assets break out where they could be exempt because Illinois has a $4 million level for their estate tax exposure, the problem is if John dies first, Mary's going to roll over his IRA, and that would only leave a small amount of assets exempt from it. So when Mary gets most of the $7 million, she's going to be exposed to estate taxes for the state of Illinois. And who knows about the federal in the future. So one thing we talked about with John and Mary, because they do have some charitable interest, especially with their church, we explained that, well, qualified money is the worst asset to die with. And so what we could do is use a wealth replacement trust, buy a $3 million second to die policy, and leave that to the kids, and then change the beneficiary of the IRAs to the church. And this would eliminate all tax on that and minimize the tax that Mary'd have to pay if, in fact, John dies first. You see, people don't necessarily need life insurance, but often they need liquidity, and there's a cost to liquidity. If you're holding a lot of cash on hand, you might be giving up on opportunity cost of doing better than whatever the fixed rates are. At least we're earning interest these days, I'll add. But there's no leverage with cash. You use a dollar to pay a dollar, and there's no leverage to it. Some people rely on paying their estate taxes by borrowing money, and there's certain rules out there regarding it, but you don't know when the death is going to occur and when the taxes are going to be due and what environment you're in loan-wise. Just go back to 2008. It was a really bad time to die because not only were business assets substantially down, the borrowing availability out there was locked up and fewer people were lending, even though the rates were better than today's rates. But you have to pay back money and with interest. So that's actually reverse leverage or negative leverage. You're spending more than a dollar to pay a dollar. You could sell something, but if it's the family business and you're trying to avoid that kind of a shrinkage, you have to find one of the other ways to work. And so that's why adding some life insurance in the mix, it's nothing more than leveraged cash with a timely delivery, providing a known outcome and often at pennies on the dollar. These are some of the reasons why people use life insurance. It's simple and easy, and we know what we're going to have when we need it, if it's set up properly. And so there's tax advantages to life insurance. It grows tax deferred. It is income tax free most of the time. It can be estate tax free if owned properly outside your taxable estate. And it provides tax diversity. And some of the time, believe it or not, it might be the most economical way to provide that liquidity as needed. And just another note that life insurance is often protected from creditors and predators. So we're sitting here looking at the laws changing in 2026, and the lifetime exemption is expected to be somewhere around 6 or 7 million by the time they inflation adjust it. So it's going down from the 13 million today per person to somewhere around 6 or 7 million with some inflation adjusting on that. The annual exclusions today are 18,000. And what we know is the government came out a while back and said, hey, we're not going to claw back anything. In other words, if the exemption goes down to the 7 million mark and you've given away 3 million, it's not going to count against your 7 million. It will account for part of the 13 million. So you still have your full exemption there, and they won't claw that back from you. So gifting now makes sense for some people that have large enough estates, and doing whatever legal maneuvering you can do. We just went through that with the football field. It's important to get working right away, because a lot of people think that if you haven't engaged with a good estate planning attorney by the first quarter of the year, you're going to maybe have a problem getting in line with how much they're going to be working to take care of their high net worth clients. So of course, that takes time. There's complexity to those things, and of course, a cost. And life insurance, again, it's a leverage tool. It's a tax-free tool, set up properly, and it's kind of simple for the most part. So for those who aren't really sure what they're going to do or if they're going to have a tax and so forth, we have recommended for some to buy some quality term insurance that's convertible to permanent or second to die later on. And now you keep your options open and you put a Band-Aid of liquidity on there as needed. So let's roll over into our case studies. We're going to look at how to eliminate estate tax exposure in a situation, how to remove life insurance from the estate, looking at cash gifts and leveraging with life insurance, some unique estate carve-out scenarios, and we'll talk about the worst assets to die with, which is qualified money for people exposed to estate taxes, that is. So Ruth is 65 years old. She has a net worth of $4.5 million, retired, looking for a little bit extra spending money, if you will, cash flow. She wants to maximize her assets for the heirs. She doesn't like the fact that she's going to have to pay an estate tax for the state of Illinois, because unfortunately that's where she lives. And she does have significant non-qualified assets available to help in the mix. And so this is what we can design for Ruth. We would use an annuity arbitrage situation, essentially. So we're going to take $1 million of her non-qualified assets. We're going to create a life-only annuity, no contingencies there, because we don't want any assets to pop back into her estate once she passes. And that creates $71,000 a year net of tax. She's got $65,000, and now we do the wealth replacement trust, if you will. She creates an ILET. She buys $1 million guaranteed life insurance policy. That'll take $20,000 out of the cash flow, leaving her with $45,000 a year to spend. Now, couple other details here to be aware of. Ultimately, once the annuity is paid out, the principal back, then all of that money becomes taxable, not just the exclusion ratio part. And emphasizing that with a life-only annuity, for estate purposes, if she dies the day after this transaction is put into place, then for estate tax purposes for the state of Illinois, her net worth is $3.5 million, not $4.5. So in her scenario, we eliminated the estate tax exposure. We avoid federal, of course, because she's lower than what we expect those to be. We replace the annuitized asset with the life insurance, so the heirs get everything instead of everything minus the tax. And she's got increased spendable income. And what we talked to her about is, if you're not spending this money, we don't want you to accumulate and start growing beyond the 4 million again. So maybe you want to consider some lifetime gifting and watch the kids and grandkids enjoy it along the way. And again, I emphasize we would have no contingency on this kind of planning because we don't want any residual from the annuity to come back and push us over that amount. This is what you can do in certain states, and there's 12 states right now that have an estate tax. So even if you don't have a federal, it might be planning like this that you need to look into with certain clients. So the estate tax formula is simple. It taxes you on everything you own minus what you owe plus any life insurance proceeds. So this estate tax axiom is gift and leverage. Get your life insurance out of the taxable estate might be a reasonable maneuver for some people to do. So we have these client chronicles that we make up here. These are real life stories that we've been directly involved with. And Keith is a longtime financial planner that I've worked with for many years. He's been very successful. Along the way, he was max funding his 401k as he could. And he ended up buying some variable life and putting some money into that to, again, have some tax advantaged accumulation. But things have changed on Keith because he's been so successful. And now he is one of these high net worth individuals. And he asked me to review his variable life policies. And we ended up repositioning them, if you will. And I'll go through the details here. So on the left-hand side, his variable life policies weren't doing good if he didn't earn anything on them. And even if projecting at a 6% rate of return, we were going to have some trouble with one of the policies in the long run. And note that the death benefit combined was this. So both him and his wife had a variable life policy. And, we just did in-force ledgers and showed them, not enough gas in the tank. We need to put more in if you want these around. But but his needs have changed through the years, where he started using these for regular life insurance protection and some tax advantage accumulation beyond his 401k. In this situation, it's all estate planning now for him and his wife because he's been successful and he doesn't need the policies for what they were originally intended. So you can't 1035 two individual policies into a second to die. And you need to get the policies out of the taxable estate. And so what we ended up doing was annuitizing the cash value of 173. That was a SPIA for him and a SPIA for his wife for just 10 years, and then the income ends. And this gives us 19 grand a year, 17 net of tax. He needed to add an additional 4,000 out of his pocket each year. And for the next 10 years, he's going to fund $1 million second to die. And the only thing we're missing from this is when the second death occurs. But we know that if it occurs 35 years out, that the net rate of return of this transaction is 5.26%. Again, net of any taxes, net of any management fee, as insurance goes. So this is an idea of getting insurance out. And in this case, we reposition the insurance to do better and work better for the estate planning that we were trying to do. So again, replaced underperforming VUL, eliminated estate tax on the life insurance, increased the death benefit versus what the variables were, and most importantly, we replaced projected insurance with guaranteed insurance. Now, a lot of people are looking to potentially gift some of their money away because they're higher net worth. And the question is, what do I do with it? And so Bill and Barb were thinking of putting $1 million into an irrevocable trust. And we wanted to talk to them about, growing the money versus using insurance leverage. And we just did a comparison that said, here's what would happen if you have 6% growth on your money. Again, these are net numbers. That's what the AT after tax, net of management fee, net of taxation. We're just using a net number to compare to the insurance. So obviously, if he keeps his money and it's estate tax down the road at 40%, you can see what the net's going to be. If they gift and grow the money, it could surpass the insurance value at some time, no doubt about that. But gifting and leveraging into life insurance was a for sure thing versus a projected thing, and an example of what $1 million gift could leverage into for a 65-year-old healthy couple. So the idea is to gift some of that 13 million lifetime exemption away before they change the exemption and while there's still no clawback. And then for those who want to project and compare investing versus life insurance, I'll just tell you that only hindsight's 2020. You may or you may not out invest insurance. There's a lot of variables missing that we need to keep in mind about what you're really going to earn when somebody dies and so forth. So a fairer comparison of a fixed life insurance policy would be to compare it to bonds. And of course, if we're looking at the market, then we might look at some variable life designs with growth intended. But the question when I design life insurance, the first question is, do we want projections or guarantees? Because that would be a different kind of policy in those situations. So for those of you who've come in a few minutes late, I want to just emphasize that we are recording today's program. And you will get a recording with a few resource pieces, which we'll share at the end. I need you to log 50 minutes in. So we have about a 50-minute presentation with some 10 minutes of Q&A. So stay on through the Q&A and log the 50 minutes, please. And we do have a survey in your browser when you log off the call today. We appreciate you filling in the full survey. At least fill in your CFP code or let us know if you're not a CFP. Now, if you have to leave like I do immediately after the meeting, then in 24 hours tomorrow at 10, you'll get an email with the same survey. So if you can't fill it in today, please fill it in tomorrow. We want to file for the CFP credit in timely fashion. I appreciate your help with it. So Life insurance is used for estate carve-out situations. Many are aware of a special needs kid situation. If I create a special needs trust and fund it with life insurance, then I can carve out that kid from the rest of my estate and plan as normal for the rest of the estate and the kids. Sometimes I use life insurance for special arrangements. Maybe one of my kids has some kind of gambling or drug problem, and there's no way I want to leave them lump sums of money. So I might carve something out and create an annuity or lifetime income for that kid upon my passing versus handing them the pile of money. Charity, as we discussed with the John and Mary situation, we can use that, and we're going to go in detail on one of those next. But oftentimes you might have charity involved, and life insurance will help leverage or replace the assets, if you will. And then divorces or remarriages. We just did a case with a client that was remarried. The lady is a little bit younger than him, but she's not going to be cut in on all the wealth that he has. She's going to get the insurance proceeds that he just set up for her. And we're talking about setting up some long-term care for her as well. So he's taking care of his current wife, but she's not equal. She's not sharing in all of what the kids are going to get because the kids are not her kids. They're from his prior relationship. So as I like to put it, life insurance is the great equalizer, if you will, and a way to, it's a lot easier for your current spouse to know that you're just taking some premiums out of the cash flow than taking millions out of her, what she presumes is her inheritance later to give to the kids instead of her. So moving on, the three worst assets to die with are: one, qualified money; two, non-qualified deferred annuities; and three, non-stepped up basis assets, which are generally lifetime gifted assets where you have a carryover basis. This is a good time for me to breathe and say that I'm neither an attorney nor an accountant, so don't trust any of the numbers that I'm giving you, but they're as good as I can find in softwares and such as we crunch them. Excuse me. I may also have not added a minute ago that if you have questions, you can add them to the Q&A box, and we'll get to those at the end. So let's dive into a case scenario here about the worst asset to die with. This is a married couple of 65, and they have $3 million in their IRA. We're using a 6% projected rate, and you can see the rest of the assumptions there. And so what we're looking at first is just income taxes, okay? So this is an estate tax planning idea, but qualified money, again, it's the worst asset to die with for high net worth clients because it's both income and estate taxed. And so let's just look at it first with no estate taxes, just the income tax. So we show that at 6%, the 3 is going to grow to 5. That includes taking out the RMDs along the way, so you know. At the passing, there'd be $1.7 million in taxes under the IRD, or income in respect of the decedent rules. And so the current do nothing strategy would net the kids $3.2 million at age 90, 25 years out of the $5 million balance that's in the IRA. What we propose is adding a $3 million life insurance owned outside the taxable estate, and we're going to start pulling some money out of that qualified plan now to pay for that. And there's something I want you to notice here that's a little bit unique and misunderstood. Even though we spent $1.1 million in life insurance premiums, that $45,000 over the 25 years, even though we spent that, notice that the balance of our IRA is only about $750,000 apart, 800 maybe. The point there is that when you pull money out earlier on your qualified plan, you lower the trajectory of the RMDs. So the future RMDs go down some because you're pulling some out on the balance, and that ultimately leaves more than you would. But note that just under the income tax scenario, the kids can net 5.7 versus 3.2 million, and that's better. So that holds throughout, even though we highlighted age 90. This is a grid just showing that that separation is there most of the time as they spend down the IRA. It would, if there's no IRA left, if they live that long, of course, then the life insurance is still there. So let's look at it now with estate taxes, okay? So when I add the estate taxes in there, the kids are going to net $1.9 million. And when I add the insurance and estate taxes, the kids are going to net 4.6. So they're 2.7 roughly ahead million. But what if going back to that John and Mary thing, what if we cut the charity in and leave the IRA to the charity? Well, if we left the IRA to the charity, then the charity would have the 5 million minus estate taxes, if you will. We'd take that out of there, but the charity would get about 4 million, and that's better for them, of course. And the kids would get 3 million. And note that 3 million, if we gave away the whole IRA to charity, then there's no estate or income taxes on it. The charity gets the 4.2 million. And the kids get 3 million, which is 50% more than they would have got with no planning. So again, this is known as a win-win, right? And this is how life insurance can help leverage and design things to work a little bit better. So we'll move on here. Just in summary, minimizing the bad asset to die with. By thinking about leaving the qualified money to the charity versus the kids. Maximize good assets to die with. That's life insurance or stepped up basis assets, of course. And what happens to be the worst asset to die with might also be the best asset to leave to a charity. And the beauty of this is the flexibility of it. You're not making an irrevocable decision today to leave the IRA to a charity, because you can always come back in and change the beneficiary of your IRA back to the kids if you change it originally, or later as you're more comfortable with the wealth you control. Perhaps you at that time are going to change the beneficiary to the IRA. This is normally going to happen after the first death has occurred for a married couple, to be clear. And for those who are going to wait on the RMDs, again, waiting to pull money out might be good income tax planning advice, but it also might be bad estate tax planning advice. We didn't wait to pull money out of the IRAs. We pulled money right away to purchase that life insurance. And then for those of you that follow Ed Slott, now that the Stretch IRA is taken away from most individuals, there's an article which I think is part of our kit for you, but it discusses the fact that the life insurance is the new Stretch IRA. So you've seen this example work both for just income taxes. In addition, it works even better when there's estate taxes. So moving on to the second worst asset to die with, I have to tell you, I've been around a while. Years ago, when the estate tax exemptions were much lower at 600 and $1 million or whatever, I would hear people say, my client's pulling RMDs out of the qualified, but they don't need the money to live off of, so we're paying our tax and we're putting the money into a deferred annuity. And I would always be like, wait a second, let me get this straight. You're going to take the money out of the worst asset to die with and put it in the second worst asset to die with? Well, that doesn't make sense. Why don't you consider life insurance? But some people hate life insurance even more than annuities. Some people hate both. But again, it's just a tool. It's a financial tool. It either fits or doesn't. They either want it or they don't. The beauty of the product really is in the eye of the beholder. And, it's only a tool if you use it. So we recently ran into a situation where Mike and his wife are doing very well. Mike had this variable annuity. We were doing some other annuitization stuff for Mike, but the advisor brought up the variable annuity with me. And I said, well, it's just a tax ticking time bomb. And if he's looking now to increase his income and stuff, why don't we just annuitize it and make a lifetime income for him too? And so we did that. It's going to provide him $1,200 a month for the rest of his life. And, and there's a tax advantage for it for a while, but once the full principal has been paid, then it will all become taxable down the road the way the annuity taxation works. So we are at our case studies for part 2. We're going to look at a Roth conversion alternative, talk about not overfunding qualified money as much, discuss the family business when that's involved with larger estates, and different things that we do for advanced planning cases. So the Roth conversion, I understand that it can be good income tax planning, but for those with estate tax exposure, or those that are going to have estate tax exposure, the problem with a Roth is the asset is still in your taxable estate. And I understand as well for these Roths, as income taxes go up, there will be less excitement about doing a Roth conversion, right? So we had a situation a couple of years back where a client was discussing recharacterizing his IRA over the next 10 years at a pace of $100,000 a year. Now he was going to pay the tax from his personal assets, so we haven't addressed that. It's equal whether he really did the Roth or does this. But we showed him, hey, wait, you're going to have estate tax exposure, and in your scenario, you're going to still own that. And so let's look at what really is better for you. So again, we're projecting at a 6% net rate of return. There's in this case, there would be no, there's taxation when you pull the 100 out and recharacterize it, right? But we're not accounting for that. It was the same number. If he pulls it out to do the Roth or pulls it out to buy the insurance and gift it, he still had to pay that tax out of his pocket. And so very simply, the Roth IRA would be $106,000 after the first year. 30 years down the road, he'd have $4.4 million in the Roth, but because it would be estate taxable, it nets to 2.6. And we immediately bought $3.5 million of second to die in an irrevocable trust, leaving $3.5 million net. So life insurance can compete well, and we can argue this all day. Well, maybe he's going to earn 8 or 10 or whatever, but the higher the potential return, the more risk you're taking, whereas what we're presenting is a guaranteed option. And so some people want to balance their risk by adding some guarantees into the mix and creating some liquidity from life insurance. So beginning with the end in mind, our high income earners of today might be these overfunded, don't need all that money in my IRA people tomorrow. And so should they continue max funding? Should they look at any life insurance liquidity to help diversify things and create cash at a time that it might be needed? So we're going to share a story about Dr. Slatt. Again, client chronicle, real life story here. And Dr. Slatt was doing very well when I met him. He was in the $600,000-700,000 a year income. He was owned part of his practice. His wife was a good income earner as well. He had already bought some other life insurance and such. And our conversation, quite frankly, was on long-term care protection. That's how this started. And we acknowledge that, hey, you won't miss any matching if you cut back on what you're putting into your 401ks, but you're growing, you're funding a product, you're funding an asset that's going to be a tax problem later. And you already know that you want to leave legacy and such with the insurances that he already had in place. Long story short, he bought $1 million permanent life insurance policy with a long-term care access rider. Now, a lot of people, when somebody's rich, they just automatically poo-poo that they don't need or want or care to discuss long-term care planning with their clients. But I want to let you know, we place long-term care of different types on wealthy people on a regular basis here. Nobody's putting a gun to their head to make the purchase. They understand liquidity. They understand that if I need care down the road and most of my money's in my 401k, I'm going to have to pull 30 cents tax on the dollar to pay for care, and that shrinkage that I could avoid by just having tax-free benefits they also understand if they have to liquidate some position when it's down, they're going to realize losses. So having the liquidity is an important thing. And so what Dr. Slatt did, he did this both for him and his wife. He already had spousal lifetime access trusts in place because he had a significant amount of term and some other permanent insurance, and they were all owned by the slats. And the value of a slat, if you're not familiar, is that it allows the death benefit to be out of the taxable estate, but yet allows you to access benefits within the trust. And so in this case, the benefits in the trust would be the death benefit being accessible if a long-term care event happens down the road. And so we funded this over 10 years. And all we're waiting for is, when does Dr. Slatt die? If he dies in 40 years out at age 88, it was a net 4% rate of return. So again, a bond-like return, or even better, net of tax and net of management fee, he made a 4% net if he dies that year. And so earlier the rates are better. If it's a little bit longer, he's still going to have at least a 3% return. So what we do for him, again, we minimize some bad assets, not continued the overfunding of the qualified. We gifted some money and leveraging it. We're owning it in a slat, so it's not a tax problem compounding as a state. Create tax-free money for care or legacy, and provided some tax diversity and an uncorrelated asset into the mix of his assets, because life insurance is going to be the death benefit whenever they pass away. So the family business. I have to tell you, being in the Midwest, most of the high net worth people that I've met and worked with through my career have been one of two things. They either made their wealth from real estate, or they made it from a family business. Now, I understand a stock and a company and stuff can do well, but that might be more West Coast stuff of people in the tech areas and so forth that were rich because of their company stock, or they were potentially an owner in the company or an early founder. So the problem with the family business is the need for liquidity is even worse. So this is why when you're looking even at term insurance on your higher net worth clients and your business owners, I suggest you buy quality term that gives them the option and the right to get good permanent later, because often they're going to come to realize the value or the necessity of having it. So what we look at in a business, and I sometimes put these pies in front of somebody when I first met them, and just, I draw the circle and I say, you draw in what's the, this stands for your whole empire. And I'm working off the today chart for a second. Often we see business owners have most of their wealth tied up into the family business, and so they'll have few personal assets. They hope that it gets to what we're looking at 20 years later, but often it never changes. The circle gets bigger, the empire gets bigger, but the percent between personal and business doesn't change that much for some owners. And so even if it does, let's take this 20-year out circle here and add some realistic scenarios here. The daughter works in the business and is going to take over the full business. They're high net worth, where they have estate tax planning to do. The other kids that don't work in the business need to get something, maybe not as much as the daughter, but how do I divide the pie up? How do I give the full business to my daughter, pay a good significant chunk to the estate tax person, have enough to be what I would consider fair to the other kids? And the bottom line is, often you won't, or you don't, and you have to inject liquidity, whether you borrow or cash out or sell or whatever. Again, those are some of the constraints. And so what we do with certain business owners is we get to gifting and stuff. They're not ready to necessarily give away the empire while they're still there running it, but they can use vehicles like family limited partnerships and family LLCs to divide the undividable asset, if you will, and they can give away shares while still retaining the control of the company. So a lot of founders are, until they're later in life, they're not ready to give away the empire and want the kids to work more and such. But for estate tax planning, the sooner we get the growth of the business out of your estate and outside of the taxable estates of even the heirs, using dynasty trusts and such, the better off we are. And so this is where you can shrink and gift and still control the assets when you're doing business planning like this. And I liken us back again to the need and the cost of liquidity, because there's moments in time when having a lot of cash on hand might be a smart thing. Today, because we're earning interest, it is a better thing than it would have been just 7 years ago, or in that stretch where we've had virtually no interest on cash. But there's no leverage. And if you're going to owe 50% estate tax on your entire pile, it's rare that you're going to have enough cash. And if you do, you're probably have some opportunity costs from piling up on cash. Relying on borrowing, there's even some governmental things. If your estate is so much percentage of all your assets, or excuse me, if your family business or farm is a large enough percentage of your overall assets, they give you some favorable lending rates and such. But again, when you borrow, it's got to be paid back. It's got to be paid back with interest. And you don't know when you're going to need this liquidity or what those rates are going to be at that time. Certainly, interest rates are a lot higher today than they were the 7 years ago. If you have a family business that you're trying to retain in the family, then you can't sell it. There's all kinds of stories about people who had to sell the best asset in the estate. One would be the Miami Dolphins story of Joe Robbie. And I love telling that story because Joe Robbie was a tax attorney early in his career before he became a real estate mogul and an NFL franchise owner. And long story short, his roughly 30 million estate shrunk down to about 35 million because they had to fire sale it. They didn't create the liquidity, didn't have things, and the husband and wife died within a short period of time of each other, and they just didn't get it set up. So don't know if he was in denial or procrastinating, but he certainly can't claim ignorance in that situation. And so this is why people insure. They understand it's just leveraged cash with timely delivery, known outcome, and often pennies on the dollar to buy it. So when you're dealing with these situations with business owners and life insurance and estate tax planning and such, it's real important who you work with as your insurance expert, because there's a lot to know behind this. And this is where we stand and shine with our history and street cred, if you will. So I just want to throw out a case that we've worked on and all the important steps and things where we were working hand in hand with the attorneys and accountants along the way. But we had a situation with two business owners. We started with a cross purchase buy sell at the time, where A owns on B and B owns on A. But along the way, they decided to sell the business. And at that time, they wanted to get their own insurances back. And so we had to look at, we do avoid transfer for value by giving the policy back to the insured. And so they swapped policies. There was a little bit more detail to that. And then it came time to get the life insurance policies out of their direct ownership and back and into an irrevocable trust. So we could either gift the policy and be subject to the 3-year rule, or we can sell the policy. And under selling a policies, there's 3 different formulas out there to use: the interpolated terminal reserve, or PERC, or market value. All of these are things that complicate a scenario. So it's a question of who your insurance partner is and do they know this stuff or not. Anybody might be able to do a mom and pop insurance, term insurance sale for you, but getting into these more involved cases is certainly an area where we shine and have a lot of background in it and a lot of resources to draw on when it gets over our head just the same. So What other strategies do we use to avoid gift taxes? Well, you might have heard of premium financing or private split dollar. And I'm not here to tell you how those work in detail, but understand from an estate tax axiom standpoint, these are ways to freeze estate assets. And when do you use them? What situations are these strategies used in? Well, you use them when somebody's cash flow poor, but they're asset rich. Again, a company being the majority of their assets, or a lot of real estate that they have that they don't want to liquidate when they pass. You might use it for people who have few or no more exemptions remaining. Some people are already, they've given away their maximum exemptions. They're using their annual exclusions to gift to the kids or use to pay insurance and such. So they don't have any more. And this might be when we'd use these strategies. There's an opportunity cost. I'm not going to take money out of my business to buy this liquidity insurance because I'm earning 18% a year, and you're not going to do that good in your insurance. And so sometimes we will allow them to invest and we'll finance it elsewise to have the liquidity with the insurance. And sometimes you do it for an arbitrage play. Hey, if I can borrow at 5 and make 7, that's a good thing. I'll do that. One thing, rule number 1 on entering any split dollar or finances, you need to design your exit strategy at the time you're entering into one of those agreements. It's an important thing to do because these are some problems and lawsuits that I've seen with people where they tell you all about the roses, but nobody told you about the thorns. And we've already seen some of these premium finance things come to legal challenges already. As interest rates went up, the interest paid went up rapidly, and the assets needed to pledge for collateral are needed. And anyway, there's some really upset people that didn't fully understand the risks here. So we will make sure if those strategies are used, clients understand them thoroughly, both pro and con. And so what are you to do here? What do we do with all this? We've got roughly a year and a couple of months before the estate tax laws might revert back, and the exemption is going to substantially go down for federal, and some of your clients are now going to be exposed to estate taxes if they weren't before. And so one of the things, just be aware of it. You've done that by sitting in today, and we'll provide a few other resources, but create your team of advisors. Who's your attorney? Who's your accountant? Who's your insurance professional that you would work with? Excuse me one second. Identify your high net worth clients that are on the marginal fringes of having either a state or a federal estate tax. Determine what strategies to educate them on and explore. And most importantly, decide what you care to do, and document the whole conversation along the way. Because at the end of the day, our job is just to explain these things to them. It's their job to either act on it or not. So life insurance again versus that football field you've seen earlier and all the legal maneuvering you can do. By all means, do all the legal maneuvering you can do, but some people never get there. And life insurance has value with or without estate tax exposure, as we've shown. It's a tool that creates leverage and liquidity. And excuse me, it's a plan that works and a valuable asset to own. So on the board here are those 3 of the pieces that we'll include, along with a recording of the presentation. And I'm going to get to the Q&A here in a second. And I just want to emphasize that appreciate you spending time to learn with us. I apologize that I don't have the other 2 dates. Hold on. Yes, I do here. So our next no, this was the second half year. I apologize. I don't have the second half year, the dates ahead of me here, but we're doing a presentation next month on annuities. And in December, we are going to premiere a brand new presentation that's part of a 3-part series that's going to look at life insurance inside and out. So the first one is Life by Design, and we'll give a brief history of life insurance industry and the policies and how they work from a macro view. And then we'll get into micro and then design strategies. So with that, I'm going to look at our Q&A here. Give me a second. If we have any questions, I have to find our Q&A box. So somebody's asking about the clawback, and I'm going to preface my answer with you in the fact that, again, I'm not an attorney or an accountant, but I try to learn these things and spew the right stuff. And they're asking that the clawback was only for things above hold on. So if you gave let me just read their question clearly. I thought the clawback was only for gifts above the 2026 projected rate. So if you gave 13 million now, then there is no clawback for the amount above 6 million. That's correct. We're saying the same thing, that if you give away anything, it can count against the 13 million exemption, but not be taken away from whatever the exemption is after the law goes back and reverts back to it. So somebody who gave away $4 million today will still have their 6 or 7 million full exemption tomorrow because they didn't give away more than 13. That's how I understand it. Give me a second here. So could you discuss why one wouldn't place assets into their revocable trust to avoid estate taxes? The difference is just the word revocable versus irrevocable. All the assets in your revocable trust are assets in your taxable estate. You still control them and therefore you own them. So only assets that you would give to the kids as an option or put into an irrevocable trust of some type. And remember, a SLAT is a form of an irrevocable life insurance trust. It has some unique features to it, but the spousal lifetime access trust is a flavor of an ILET, to be clear. So anything in a revocable trust is part of your estate. So if you're thinking back to the converting the Roth and owning that in your estate, if you in your trust, it's in your taxable estate and will be taxed then. Somebody had asked, in the SLAT scenario, was the premium only paid for 2 years? No, the way we presented it, premiums were paid for a complete 10 years, and then the policy was paid up. And we just showed the first and the 10th year because we were showing different years, not every year in the example. So sorry for that confusion. I appreciate you bringing that up. And let me see if we have more questions here. So I am going to stay on the whole 10, until the 11 o'clock time period. If you came in late, stay on with us. Feel free to throw some more questions in the Q&A box here, if you will. But make note of our presentations. When we send the kit, we'll have the exact dates. I apologize. But next month is on annuities. And December will be a new presentation about designing life. We can take more Q&A if you like. So somebody's asking, this is an interesting question, and I think more of a situation understanding would be there, but are ILETs beneficial to folks with assets below the exemption amount as long as there are funds in an IRA? Again, the way, the scenario that I'll put in my brain here, this is something that I talk to people about who have no estate tax exposures, whether it be state or federal, but They are concerned about spending down their assets to live off of, or they're concerned about the exposure of long-term care. And so when we talk to somebody, let's say we had a couple worth $2 or $3 million, they may or may not buy they may or may not buy long-term care insurance because they might think they have enough. Well, my question to them next is, look, if you want to leave something to somebody, you might want to remove it from your taxable estate and put it in an irrevocable trust. So somebody might put their house in a land trust so that at least the house won't go to the nursing home if in fact they do need care later, didn't have insurance or didn't have enough insurance, and they're spending down their assets. So again, those would be things you might use. The special needs trust is something to get assets out of your estate and for your kids. So the answer quickly is yes to your question. You might still use ILETs, spousal lifetime access trusts and stuff, either to avoid being pushed over into an estate or assure that the assets are there and won't be spent by your estate if negative things happen down the road to it. And with that question, I'm going to stop our recording here, and we can still answer Q&A.